Good morning, afternoon, evening, whichever it is for you. This is a quick view of Introduction to Managerial Accounting, AC 201, chapter 14 in the book. And we're just kind of do a compare and contrast of them and kind of go over some of the basic concepts in managerial accounting. So first of all, managerial accounting is an activity that provides both financial and non-financial information to an organization's management and its internal decision makers. This is the biggest contrast it has to financial accounting. Financial accounting is primarily for external users. It's for people outside of the company. It's its investors, the people who give it loans, buy its stock, things like that. Whereas managerial accounting is more for your internal users. It's for your CEOs and CFOs and upper management and middle management, so they can see what the company's doing and make decisions based on that information. Because of that, there are two other major differences. The big one here is, as you can see, in managerial accounting, the only overriding constraint is cost benefit. So when they look at how they're putting this information together, what information they're gathering, they're wanting to get the information they need to make the best decision based on a cost benefit analysis. What's this going to cost and what's the benefit, and is it worth it? So they're going to put it together whatever way best suits that. Whereas with financial accounting, GAAP tells them what they can do. GAAP does not govern managerial accounting. There are similarities between them in some situations, but that's purely because whatever GAAP had set just happens to work out for the cost benefit constraint. So those are your biggest differences between the two. A quick note about ethics and fraud. Ethics is very important in managerial accounting. Obviously, this accounting here affects the information within the company, which is eventually used for the financial accounting for the statements that are presented. And as such, it's important to have strong ethics here and have strong controls to prevent fraud. So there's some minor discussions in your textbook about this, but there's other things you can read about it. Just want to make a quick note of that because it is very important to have those in mind when doing managerial type accounting. So things with managerial accounting. There are 5 types of cost classifiers, classification for costs within managerial accounting. Behavior, traceability, controllability, relevance, and function. All right. So these are how everything is classified within the accounting field for management to look at. We're going to start with behavior. At a basic level, a cost will be considered as fixed or variable. All right. So fixed costs are costs that don't change. Building rent, utilities in some situations, things like that, where it doesn't matter how much you use or what you do with it, you're going to pay the same amount either way. So like I said, building rent's a good example. Another one would be a phone plan. So you pay one monthly fee regardless of how many phone calls you make, how many texts you make, how much time you spend surfing the internet and data and all that stuff. A variable cost, on the other hand, changes in proportion to changes in the volume of activity. So utilities can fit into this one as well. A utility is a good example of water. The more water you use, the higher your water bill. So that's a variable cost. The same goes with manufacturing. There are lots of different variable costs. The more employees you have to have working on a particular project, the higher your rate of pay is. Those become variable costs. The more hours you have to spend, the more it costs. And then mixed costs are ones where it's a mixture of the two. Phone bill, again, is a very good example of this one, and that a lot of phone plans now, you pay for a certain set, and that's fixed. You will pay that much at least, no matter what. But if you exceed a certain limit, data, talk time, things like that, then you pay an additional variable cost, 10 cents per minute, or 10 cents per a megabyte of data, however it works out. And so your cost goes from being fixed to variable depending on what your usage is. There's also situations where you have a fixed set plus a variable on top of that. That's a mixed cost setup. Moving on, traceability. So costs can be traced either directly or indirectly to what it is you're selling. That's what we're trying to do, is assign all these costs to the products we're selling so that we can figure out how much we need to sell them for to make money. So a direct cost is one that can be traced directly back to the product we're selling, or that batch of products, or that product line. So if, for say like the wheels on a car, I can buy that wheel from the person who made it, take it over and put it right on that car. I know exactly how much I paid for that wheel, and I know exactly, what line of cars it went on to, or exactly what car it went on to, and so I can trace that cost directly back to that car, that product. Indirect costs, not quite as straightforward. The manager of the car factory. All right, so we pay him a salary to watch over the factory. Well, that factory may make, Escorts, and then it may also make Escalades and all kinds of other vehicles. Who knows? I know I'm blending makers. But how do we assign the cost of his salary to one product? We really can't. So there's no direct tracing of it to a product. That's an indirect cost. Indirect costs are kind of dealt with in a different way. Since we can't trace them directly, they're often kind of set out. We break them up into chunks based on how much time he spent with this, or how much product the factory made of this one type of product. It depends. You'll see that can get very complicated fairly quickly if you're not thinking about it the right way. So, but it's they've got ways to deal with it. So don't get too frightened about that. Controllability. All right. So this is a cost right here that is used more for judging management. So it refers to management's control over that cost. So lower level management can control the amount of hours that an employee works, or the amount of employees that work a certain day. They set the schedule, they assign them to tasks, those kinds of things. But they don't really deal a whole lot with taking loans out for the company. So that the cost of a loan wouldn't be something that's controllable by a lower level manager. So we wouldn't want to judge his performance based on that cost. So that's what controllable and non-controllable costs refer to. It's which person's in control of that cost, and we want to make sure we assign that to him when we're looking at him, so we can decide, is he doing his job well enough? That's what those are for. All right, relevance. This is very important when it comes to making decisions regarding the information you're presented with and how you present it. So sunk cost is one that cannot be avoided or changed. So we bought a building to do this manufacturing in, and we pay so much in mortgage fees or whatever for that building. We've decided we want to change the way we do this, and we were thinking of getting another building. We wouldn't consider the cost of the building before because it's sunk. We're going to pay that no matter what. So it's not considered. It's irrelevant for our decision making at this point. It's very important you're able to identify what the sunk costs are when you're putting this information together, and you don't include them, because including sunk costs when they shouldn't be included can have a huge effect on your decision making. The out-of-pocket costs are the ones you really want to focus on, the ones that are going to have an effect. These are costs that we're going to incur in the future because of this decision, or costs we won't incur in the future because of this decision. Both of those need to be considered. It's things that you are avoided or changed in this decision. And then the opportunity costs is another thing to consider, and this one can get kind of tricky at times for some people. Opportunity costs are those that you had the opportunity of, but you didn't take it. So we decide that we can either build Jeeps or we can build Escorts, and we decide to build Escorts. Well, the opportunity cost here is what we would have gotten if we built the Jeeps. So it's the exchange up. It's okay, by taking this decision, we gave up the opportunity to do something else. Right? And so that's sometimes difficult to always identify, and they can get very vague at times. But that's an opportunity cost now. Classification by function. Right? So product costs and period costs. These are very important, and I believe it mentions it here. That you are able to classify these differently, because these are the ones that down the line it'll have an effect on your financial accounting. If you accidentally identify a period cost as a product cost, then instead of it showing up on your income statement, it's going to show up on your balance sheet. You know, same thing goes with the other way. You know, it'll change where they're put on your financial statements if they're not identified properly. Product costs, anything that can be traced back to a product. So the materials used to build that product, the labor that actually hand puts the product together. If management only oversees that one product, you know, you have a manager and all his job is to manage the factory line for that one product, then his costs are going to be a product cost that you can trace back to that product. Period costs are going to pretty much be everything else. If you can't trace it back to a single product or product line or product batch, then it's a period cost. Period costs are treated the same way that financial statement costs are. So a quick note here that I'm being presented with is a good example of how this can be an issue is Health South, as everyone knows, actually had the bad habit of intentionally misidentifying period and product costs. And that's what caused them to have their financial statement issues that led to all of that. So there's an example of, you know, why it's important to make sure you're identifying these properly if you're looking for one. Then moving on from there though, all right, we're going to quick sum up. Behavior costs are identified by their activity. If it's a fixed cost or a variable cost, how does the change in the activity change the cost? Traceability of the cost, is it directly attached to this? Can you directly trace it to this? Or is it one of those things where it's kind of vague? You know, well, we're paying this, but he's not really making this one product. He kind of oversees all these different things, or, you know, there's a lot of stuff going on with it. Controllability, so who has the decision making when it comes to, you know, hours, all this stuff, whose decisions affect that cost. Relevance, is it a sunk cost or is it one we can change or avoid in the future? And then the function of the cost, like I said, very important. Is this a product cost or a period cost? All right, now, any cost you identify is going to be all of these in some way. So these all affect every single cost. So back to that tire example, tires on a car. That is a direct cost. It is a variable cost. It is controlled by the lower level manager most likely, or the purchasing manager. It may or may not be relevant to decision making depending on how their raw material inventory ordering process is. If it's just in time, then those costs could be relevant to some degree. And then function cost, it's a product cost, it's not a period cost because we can trace it back to a particular product. Those tires fit into all 5 of those. You know, you can see their direct material costs are the raw materials. It can be traced directly to a single cost object. Direct labor costs are the employees putting it together. So the guy who puts the tire on the car, on the rim and on the car, his labor cost is direct labor cost. Indirect labor costs are, again, you know, the manager if he's overseeing several things, or the maintenance man at the building where they're doing it. He doesn't put any of the stuff together. All he does is take care of the building. It's still a cost the company incurs, so they're going to want to account for it and to think about it when they're making their decisions. It's just not a direct cost. And then factory overhead, which includes indirect labor to some degree, is your other indirect costs. All right. Indirect labor is just a specific version of overhead costs. Just, you know, those can sometimes get interchanged and become confusing. Okay. Prime costs and conversion costs. Prime costs are direct labor and direct materials. Okay, they can be directly associated with the manufacture of finished goods. Conversion costs are direct labor and factory overhead, right, which can be incurred during the conversion of raw materials to finished goods. So direct and direct, notice both, direct labor can be both. It kind of comes down to what the cost is. So a good example of a prime cost would be the guy mounting the tire to the car. That's going to be a prime cost. It's direct labor, direct materials. It's right onto the car. There's no break in the chain. You can see it. Conversion cost, you know, the guy who brings all the tires into the warehouse and sets them all up for the people to mount. It's a direct labor cost, but you know, he's only kind of, it's a cost that's really just incurred in the conversion of raw materials. He's not actually converting anything. So those are kind of some vague examples. Probably not the best, but the best I can come with on the fly there. Quick note about the balance sheet. A manufacturer's balance sheet will look slightly different from the balance sheets you're used to because they will have these three accounts on here instead of just one inventory account. They will have raw materials, there we go, goods in process or work in process, and finished goods. All right, so this is to represent the fact that they don't always finish everything the day they started. They'll order product, get it in. It may sit in their warehouse for a day or two. Then someone will bring the tires out, set them on the line, right? Well, the guys may finish the day up, and they still got a couple of tires sitting there. They haven't put on the car. They got a couple of cars sitting there that haven't been fully put together and painted. That's your work in process. And then when it gets to the end, they finish the cars up. They're ready to go. They drive them out on a lot, and they sit there until they're sold off to dealers. That's your finished goods. So raw materials, work in process, and finished goods all have to be accounted for separately. When you get to actually accounting for this and going through all these, it is long. It is a bit of a drawn-out process, but it's very important that it gets done. And as you do it, you'll have a better understanding of how these companies work from beginning to end. So it's a good thing to really learn and understand. Even if you're not going to be an accountant, this is very, very good to know. So let's move on to some stuff to kind of help with comparing these. All right. Zoom this in for y'all. Whoa, I might have overdid that. Just a hair. Just a hair. All right, there we go. So, quick sum up. Differences between financial and managerial accounting. The users and decision makers. For financial accounting, it's your external people. People who invest in the company, buy its stock, give it loans, those kinds of people. Whereas for managerial accounting, it's your internals. It's your managers, employees, anyone within the company who's looking for information to help them better run the company. The purpose of the information, obviously, if you're going to be a investor, you want to know what the health of the company is. How much money do they have? How much are they making in income? Whereas if you're a manager, you're more concerned about, okay, how is this working? Do I need to change something? How much am I spending here? Is there a way I can spend less in order to improve these numbers? Flexibility of practice. Oh, there it is. So financial accounting is controlled by GAAP. They're told what they have to say about what, where it goes, how it needs to be presented, what the information is that goes in there. Very controlled so that all these different external users can interpret it. Let's see here. Oh yeah, bright lines. Yeah, okay. So yeah, again, like I said, they're given bright lines. This is the way it is, and it has to be this way. If you cross this line, you have to do it this way. If you cross this line, you have to do it this way. Whereas with managerial accounting, it's not the same. The GAAP doesn't control them. They don't actually have a full standard set. There are some agreed upon, kind of just understood within different industry rules. But again, what constrains them is the cost benefit. We need just the information we need presented in the way we need it presented in order to determine the cost benefit of this decision. The timeliness of the information. For financial accounting, it's going to be mostly, presented after the fact. So this is what has occurred in the past. It's typically, you get your one annual statement and then your 4 quarterly statements. That's it. That's what you get. Whereas with managerial accounting, it's a lot of what's happening right now and what we think is going to happen in the future. And it's as management needs it. So if they decide they need to have a better understanding of what their costs are related to this project and what we're spending on it, they'll have all that information put together and presented in whatever form they want it presented in within days, months, weeks, however long they need it. The time dimension, again, as I just mentioned, financial accounting is mostly historical information. What happened in the last year? What happened in the past quarter? How much did we already spend? How much have we already made? There is some future predictions with regards to accruals and deferrals, your accounts receivable and what your allowances are. But those things are strictly governed and very, limited. Whereas with managerial accounting, very forward-looking, this is it. I mean, we project this, we're estimating this. It's very futuristic. They want to know what they think is going to happen so they can prepare for it and try and guide the company in the right direction. the focus of the information. Financial accounting is the entire organization, whereas managerial accounting may be on just this one product, this one area, this one portion of the company. I may only want to know about this one aspect of this one product. It's very limited to a specific situation. And then the nature of the information. In financial accounting, everything's presented as a dollar. So we have X number of dollars worth of inventory. We have X number of dollars worth of this or that. In managerial accounting, it's pretty much always monetary, but sometimes they don't want the monetary. You know, they may say, well, we don't want to know how much in dollars we have in inventory. We want to know how much we have in quantity. So what's the number of cars we have sitting on the lot? What's the number of buildings we own? So sometimes not always monetary. Here's another example of what I meant by these different cost, identifiers, and how each item will actually have several of these identifiers attached to it. So bicycle tires or car tires, either one, are a variable cost because the more you buy, the higher your cost goes. They can be directly traced to the product you're attaching them to, and they are a product cost because of that. Wages of assembly workers are a variable cost because the more hours they work, the more assembly workers you have, the higher your costs go. They can be directly traced to the products they are putting together, and because of that, they are a product cost. Advertising, typically fixed. You pay them one fee and they run your advertising for you. That can be tricky. Some people may want to say, well, what if I want more advertising? It's still pretty much a fixed cost. It's not like, they all of a sudden run a little more up and you have to pay. You've paid and that's it. If they decide to run more, well, that's their decision. So it's a fixed cost. It cannot be directly traced to a product. It's not like it's something you put on that product or something that was resulted from the actual making of that product. So it's an indirect cost. And because of that, it is a period cost because it can't be traced to any one direct product. Production manager's salary. Keyword here, production manager salary. Okay, fixed cost because it's a salary. He's getting paid one flat rate. It's an indirect cost because he may be over the production of several different products, but they are all products, so it is a product cost. You can trace his back to the products. Office depreciation. Building may house the manufacturing on one floor. 10 floors up, you've got the administrator, the CEO. So the depreciation itself is a fixed cost, but it can't be traced directly to any one product. You could be making 3 or 4 different products there. And again, because you might have the administration in the same building, it may not all be product related. It is a period cost. That's how you can have all these different costs related to different situations. And then a quick example of the balance sheet and the inventory accounts I was telling you about. Like I said, you'll have raw materials, goods in process or work in process, and finished goods inventory. They must be presented in this order. They are required by GAAP for the accounting setup to put things in order of liquidity. So those that are most liquid come first. Cash, accounts receivable, obviously, and then inventory. And of the inventory, raw materials is easier to sell off than the finished goods are typically. So it'll be put in that order. Okay. I'm getting a quick note to mention that period costs are expensed immediately, whereas product costs are capitalized into inventory. So that's, good point. I'm glad you mentioned that. That might make it a little easier to understand the period and product costs. So bicycle tires, obviously we're not going to write that off as an expense immediately. We're going to write that into the inventory. And then wage of the assembly workers will go into inventory. The manager's salary, because it's all product related, will go into the inventory. And then when we sell that inventory, those costs will be taken into cost of goods sold. So that's how those costs. Whereas the advertising, we're going to go ahead and write off as advertising expense within the period in which it occurred. Same thing with office depreciation. Write it off as depreciation expense within the period it occurred. So that's another way to think of this that may be a little easier to understand. But so that's managerial accounting, a quick sum up and comparison. And,
Email.
Oh, yeah, sorry, I'm interrupted again, sorry. But as I was saying, managerial accounting, quick comparison, financial accounting, and a review and concepts, chapter 14 in the books. And then that's it. Thank you very much. This is, if you have any questions, you can email at kalattutorlab@uab.edu, or you can schedule to Skype with a tutor at the Kalat Tutor Lab. It's the Skype name. And I hope you all have a good day, afternoon, or evening.